So I've said we are beginning our revision, and we want to begin with the paper of last sitting. We want us to begin with the paper of last sitting. And in that paper of last sitting, that is April 2023. April 2023. April 2023. Now, because of the interest of time, I want us to agree that you can handle the theory on your own. You can Google, or you can check in your notes. Then I tend to just concentrate on the computations. What do you think? Is that in order? I want to hear. Or you want us to answer everything? Okay, it is in order. It's in order. So if it is in order, then that is okay. So question number one, and I'm not in any way saying that you ignore the theory. It is very, very important. It will boost your chances. But because of the interest of time, let's concentrate on the computations together. But on your own, you concentrate on the theory. Now, question number one of the paper of last sitting, A says, explain 3 benefits of maintaining a cost database. So that one you shall check on your own. Part B, Roman 2, we solved in class when we were dealing with process costing. So I wish to go to Roman 3 of part B. Roman 3 of part B. Roman 3 of part B. Let me see whether I'm able to avoid this reflection. Yeah. So in Roman 3, we are told that Digital Television Limited manufactures digital televisions. The main component used in making digital televisions is the fluorescent tube bulbs. For each digital television manufactured, 12 bulbs are required. The company manufactures 15,000 digital televisions per year. It costs shillings 200 each time the bulbs are ordered, and the carrying costs are 8 per bulb per year. Determine the economic order. Oh, that is also solved. Good. Thank you, Sirao, for reminding me that. Then that takes us to question number 2. Question number 2, in the context of labor remuneration, I write 4 causes of labor turnover. That one you will get from the notes. I think I gave you a handout on labor costing. It contains very, very many causes of labor turnover. We go to part B. Part B, was it done? No, I think I'm the one who taught you overheads. Was it done? Can you advise me? I think I found when you had. Oh, it was not done. So if it was not done, we can do. And it says that Ezekiel Mutida, a sole trader, prepares 3 types of cakes branded HBL1 and HBL2 and HBL3 in 2 production cost centers and 2 service centers. The production centers are mixing cost center and baking cost center, while the service centers are distribution department and canteen department. The following is the budgeted production data and production cost for the year ending. So we are given all that: production, direct material cost, direct labor, mixing, baking, mixing, machine hours per unit. The budgeted overhead for the year are as follows. We have the department, allocated. We have rent, depreciation. Then additional information, the budgeted overheads for the year are to be allocated on the following basis: net book value, floor space. Secondary reapportionment is to be allocated using stepwise method. Then we have we are told to do overhead distribution sheet showing both primary and secondary apportionment. So we will have to draw what we call overhead distribution sheet. Overhead distribution sheet. Let's begin there. Overheads distribution sheet. Let's design that. Yeah, it looks my space is not fitting what I wanted. I have to redo the sheet again. Let me redo the sheet. Let me redo the sheet. Space is not fitting what I wanted it to fit. Let me see how far it can go to this edge. So it's coming up to here. It is coming up to here. The building is sort hapa. Okay, we have 5 departments. 5 departments. So hii ya mwisho hapa I have this next one here. I have the third department, the fourth department, and the fifth. Then I have multiplying factor. Then I have the ratio. The base. Good. So that is how the sheet will look like. Overheads distribution sheet. Overheads distribution sheet. So here I have the overhead. Here I have the base. Here I will have the ratio. And then here I will have multiplier. Let me just call it multiplier. Multiplier or multiplying factor. Let me just call it multiplier. The first department that we have is called who? It's called mixing. So this is mixing. This is baking. This is distribution. Oh, there are 4 departments. Okay, so if there are 4 departments, then that's fine. This is canteen. That's canteen. So that means I do not require that space. That's good. Haya, sasa we always start with the allocated. Allocated. Allocated is the amount which is already given per department that does not require further subdivision. So you can see there in mixing, we are given 376,975, 376,975. In baking, we are given 243,925, 243,925. Distribution, we are given 166,000. And canteen, we are given 266,500. Those are the amounts that have been given. Now from there, you talk of apportioned. Now this apportioned, it is the one the question is referring to as primary apportionment. So this has to do with the figures that are given as CGOs. They have not been distributed per department. So the first one we can see is rent. So rent, we will use the, tell me which base we should use. Tell me which base. Let me see someone telling me the base. Which base do you think we should use to apportion rent? Yeah, good, Jacinta. We are going to use the space. We are going to use the space. And if we are going to use the space, you can see the figure the way they are given there. We can simplify them. We can simplify the figures. We talk of that 6 is to 14 is to 10 is to 8. That is the ratio. 36 is to 14 is to 10 is to 8. Just removing the zeros, or you could simplify it further. Now, to get the multiplier, what you do, the amount for rent is 170,000. You divide it by the total. Add these ratios. Niambie 36 plus 14, that is 50. Plus 10, 60. Plus 8, that is 68. So tell me, 170,000 divided by 68 is how much? $2,500. That is the multiplier. So sasa utachukua hii 2,500 multiplied by 36. Multiplied by 36. 90,000. So hiyo 90,000 inawekwa hapa. Multiplied by 14. When you multiply by 14, inatupea that 5,000. I multiply by 10. Multiply by 10. $25,000. Multiplied by 8, that is 20,000. Let us share the next one, which is the depreciation of machine. Depreciation. So depreciation of machine. What do you think we should use to share the depreciation? What do you think we should use to share the depreciation? Good. Net book value. Net book value. So let's reduce the ratio. This one, I think, if we were to divide by 150,000 kila mahali, 150,000, this will be 10. 10. Hiyo ingine, you divide by 150,000, that will give us what? 5. Hiyo ingine, you divide, it will give us 2. And then the other one will give us 3. So 10 is to 5 is to 2 is to 3. So the amount that we are to share is 300,000. So 300,000 divided by, add this ratio, 10 plus 5, that is 15, plus 2, 17. Yeah, good, Vera, you can see 20. So tell me what is the answer? 15,000. That is 15,000. So 15,000 times 10, that gives us 150,000. Times 5, that gives us what? 75,000. Times 2, we get 30,000. And times 3, we get 45,000. 45,000. Okay. Then we come now and talk of reapportionment. reapportioned. Reapportioned. So reapportioned is the one that they are calling, the question is called in secondary. Just a minute. Now, in this case, in the reapportionment, we are told this, that secondary reapportionment is allocated using stepwise. Now, stepwise is a method that we also call the close down. It is also called the close down method. The close down. And what happens with the close down or the stepwise method? You come to the service department and identify the one with the highest. Now that will require us, first of all, now to get the, now that we did not get the subtotal here, add this. I should have created a subtotal, but we can still get it. Nearby 166 plus 25 plus 30 is how much? 166 plus 25 plus 30, 221. Give me the other one. So we are getting 221. What about the other one? 266, 500 plus 20 plus 45. Sorry, let me respond to this call. So if this one has 3.1, in the close down method or in the step allocation method, you start with the service department that has the highest amount. You start with the department that has the highest. So we are going to say reapportion from canteen. Canteen, naandika canteen hapo. Alafu nakuja huku mwisho, umesema ni 3.1,500. Naandika hapa 3.1,500. And you put it in brackets. 3.1,500 and you put it in brackets. Now in this one, we allocate to every department. So we have to know how do we, or which base do we use? Which base do we use? Okay, now in this case, these people are confusing us because they are saying we use the stepwise on the following basis. The following basis. So then we have to use those percentages as provided. Otherwise, if it was not provided, we should have used, we should have shared to distribution first. Then we close this, we close the canteen and go to the others. But now that they have given us the percentages, we are going to use the percentages. So the base is the percentages. And the ratio is 7:3. So utakuja hapa useme 3.1,500, you divide by 10, that will give us that 3,150. So tell me that 3,150 times 7, it is what? That 3,150 times 7 is what? 2,050. So So unaweka hapa 232,050 times 3 99,450. So in this case, the wordings of the examiner are confusing because what we know generally is that in the close down of the step, you start with the biggest or the bigger, then you share including to this one. But after the examiner has given the name, he has gone ahead and given us the percentages. So in that case, we are supposed to comply with the percentages. And that is what we normally do. In case you come across information that is contradicting what we normally do, what is done generally, you do exactly what the examiner has guided. So now that he has given us the percentages, then we have no choice than to go by those percentages. I hope that is understood. So this one is not receiving anything. Now, let's go to distribution. Distribution. Now, in the distribution, we are also using percentages. And the ratio is 55:45. 55:45. I told you don't have to spend a lot of time trying to simplify. Haya, so hii tulikuwa tumepata ni 221,000. So sasa unakuja hapa unasema 221,000 and you put it in brackets. Huyu hatapokea anything. So sasa kuja hapa useme 221,000, you divide by 100 and this will be 2210. So niambie 2210 multiplied by 55 is how much? 121,550. 121,550. Multiplied by 45, we get what? When you multiply by 45, what do we get? 99,450 again. 99,450. Okay, so if that is true, then we are through. Sasa hii nimekuambia hii ya portion is what the examiner is calling primary. This is what the examiner is calling the secondary. And I told you the other day, in cost accounting and management accounting, we have the advantage of very many words to describe the one thing. So ukipata wametumia majina yenye hujui, but the question looks familiar, just solve it the normal way we solve in class. Yeah. Because I believe in class, we never talked about primary or secondary. We talked about apportioned, reapportioned. So that is the way to go. So with that, give me the total now. Let's get the total. Let's get the total. Haya, tuanze na the part department mixing. Add zote kutoka hapa juu, kutoka 376 kuja umeadd zote, unitumie total. Uh-huh. 970, 575. 970, 575. Haya, hii ingine the second department. 552, 825. 552, 825. These ones should go to 0. Those ones should go to 0. So we have answered what the examiner wanted. An overhead analysis sheet showing both primary and secondary. That is answered. Part 2, total machine hours for mixing cost center. So we need to get the total machine hours for mixing cost center. I think I can wrap up here. I don't think I'll need the sheet again. I will not need the sheet again. So what I can do is to secure these figures. The first one is 975.75. The second one is 552.825. So that when I clear here, when I need them further, I will get them. So now the question is saying the total machine hours for mixing cost center. Total machine hours for mixing cost center. For mixing cost center. So what we are going to do is now Roman 2. You can see where we are given the mixing machine hours per unit. That one will be very, very simple. It is the units that are there, that 300 times 6 plus 7,100 times 3 plus 1,650 times 4. So give me those machine hours. 47,700. 47,700 hours. Good. That is answered. Roman 3, machine hour overhead absorption rate for mixing cost center. So Roman 3, the machine hour overhead absorption rate, absorption rate overhead absorption rate for mixing cost center. So the OAR, as you know, we normally say it is the budget overhead costs, budget overhead costs. You divide this now by budget machine hours. Budget machine hours. The budget overhead costs, you divide by budget machine hours. So our costs that we found in mixing, tulipata 970,575. Na the hours tumepata 47,700. So when you divide that, it is going to be what? $20.35. It is 20.35. Okay. Roman 4. Roman 4 is rate expressed as a percentage of direct labor. So direct labor rate, absorption rate, overhead absorption rate, In that case, we are going to use the formula that OAR will again be budget overhead costs, You divide this by budget labor costs, budget direct labor costs, or you can just write labor costs. And we are told we express it as a percentage. So it will be multiplied by 100. So we need to go and establish what is the labor rate. Or rather, what is the budget labor costs? The budget labor costs. So the budget labor costs in the baking, actually we can just put them together. We can just put them together instead of working them separately like this. That the cost that we got there was 552,825. You divide by the labor costs. The labor tunaambiwa in the baking department, labor was 90 per unit. So utachukua that 300 times 90 plus 7,100 times 50 plus 1,650 times 180 times 180. Then all these you multiply by 100. All that you multiply by 100. So that we get the percentage. $58.25. 58.25%. 58.25%. Then calculate the budgeted total cost per unit or per product of HBL1. HBL1. So we draw what we call cost statement. Draw the cost statement. Cost statement. Per unit of HBL1. 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 So this becomes very simple. You know, we always start with direct materials. Direct materials. Now that one is already given, no working. It is 130. Then direct labor, and this direct labor is in two departments. We have mixing. So in mixing, we are told it is 75. Then we have baking. Now baking, it is 90. And then with that, when you add the direct costs, the figure you get is always known as prime cost. The figure you get is always known as prime cost. Give me that total. When you add, the figure you get is always called prime cost. 295. Good. 295. Then you bring what we call absorbed overheads. Absorbed overheads. And in the absorbed overheads, you're starting with the mixing department. You know what we normally do is you take the OER. So hapa tulikuwa tumepata OER ya 20.35 per hour. It's 20.35. So you multiply by the number of hours. This one has 6 machine hours. So 20.35 times 6, tell me it is what? $122.1. 122.1. Haya, tukuje kwa baking. Baking. Now baking is giving us a percentage of 58.25% of the labor. Labor in baking is 90. Tulisema in getting the absorbed overheads, you get the OER, you multiply by the actual value of the base. So tell me 58% of 90. No, 52.425. 425. And with that, we get the total costs. You get the total costs. Total cost, obviously, per unit. So add these 295 to 122 to 52. Niambie inakuja ngapi? $469.525. 469.525. Good. So that is the total. So that one is answered. Let us go to part 3, question 3. Outline 4 factors influencing stock levels in inventory management. Those ones, again, you should get from your notes. Highlight 4 purposes of cost estimation to a service company such as a hospital. Hata hiyo uko nayo kwa notes. So let's go to part C. Ray Limited is currently following a centralized material storage system. The company is in the process of preparing its cash budget for the second quarter of the year 2023 and has availed the following data. We have the month, we have the sales, material purchases, production overheads, selling overheads, salaries, and wages. Additional information is that cash sales are 60% of the total sales. The remaining sales are collected equally during the following 2 months. Assets are to be acquired in the month of April 2023 and May 2023. Therefore, provision should be made for payment for the same. An application has been made to the bank for the grant of a loan of 45 million, and it is hoped that the loan will be received in the month of May 2023. Creditors for materials purchased are granted 1 month credit after a month of purchase. Monthly production overheads include depreciation of 5 million per month. Selling overheads are paid 1 month after the month in which the overhead incurred. Sales, salaries, commissions at 3% on sales is paid to the salesman each month. Salaries and wages are paid monthly at the end of the month. An advance tax of 20,000 is due in April. The cash balance is estimated at that. Now you are required to get a cash budget for the second quarter of the year commencing 1st of April to 30th of June. So habari ndio hiyo, kama hiyo ndio maneno. We are supposed to do the cash budget. We are supposed to do the cash budget. So in the cash budget, I have, we are told to do up to June. So we are doing April, May, and June. So hii ndio itakuwa my last month here. Hii ni my second month hapa. Hii ni my first month hapa. Na hapa ndio nitakuja niandike my details. So cash budget. So in the cash budget, I have details here. I have the month of April. I have the month of May. And I have the month of June. Now, I told you when you're preparing the cash budget, the first thing is to come up with the receipts. You identify the receipts. Where money is coming from. So in this case, if you look at that question, you can see that our inflows are coming from sales. And these sales, we have cash. We have cash, which is 60%. And then we have credit. And then this credit, we are told, it is collected equally. So that means we have 20% and we have another credit of 20%. So we have two credits because they are collected in 2 months. Information 2, it is payment. Information 3, an application has been made to be granted a loan, and it is hoped that the loan, let me see whether that is supposed to be okay. So this is not so we are going to receive a bank loan. I thought it was an overdraft, would have brought it down here. So bank loan is going to bring money. Creditors, monthly overheads, selling, commission on sales, salaries, advance. Yeah, those are the only items. Na hapo juu hakuna any other. Sasa ukiwa namna hiyo, hii unafunga. Kwambia hii unafunga namna hii. You tell us total receipts and you call them A. Total receipts and you call them A. Halafu unaifunga. Then down there, naweka payments. Naweka payments. So payments, there are very many. Ya kwanza, as you can see in information 2, there is an asset. Asset purchase or asset acquisition. And we are told there will be for 2 months, okay? An application has been made, that one is income. Creditors for materials purchased are granted 1 month credit after month of purchase. So we have materials purchase or creditors. Then there is monthly production overheads. So production overheads or just overheads. Production overheads. Then we have selling overheads. Selling overheads. They are paid 1 month. Then kuna mwingine hapo anaitwa salaries commission. So we can just call them sales commissions. Sales commission. Alafu kuna salaries and wages. Kuna salaries, wages. Salaries and wages. Kuna tax. Yeah. Alafu sasa ukishamalizana na hiyo additional information, you go to hii table ya hapa juu. Hii hapa juu naangalia whether there is anything you have skipped. Materials tumeweka, overheads tumeweka, selling na salaries. So tumeweka kila kitu. So with that, we are in a position to come and get our total payments. Total payments. And in the total payments, we have B. We call them B. After that, I told you we cross to the other side here, which is called balances. And in the balances, we bring what we call surplus or deficit, which is in brackets. And this one is given as A minus B, which is C. A minus B, we call it C. Then we bring the opening balance. The opening balance, which is D. And then we have the closing balance. And the closing balance will be C plus D. The closing balance will be C plus D. Will be C plus D. That will be the end of our cash budget. That will be the end of our cash budget. Okay. So if we are okay with that, let us now start filling the items. So tuende kwa sales. Sales in the month of April ni 150,000. So the figures are, I think we can work with our figures in millions. Figures in millions. In millions. I think that to make our, sijui kama italeta mambo mingi. I think space itatoshea. Okay, let's work it down. Thousands. So that we avoid decimals. In thousands. Aya, sasa tuende kwa April. Let's start from there. April, the sales are 150,000. So give me 60% of that. 60% of 150,000. That's 90,000. Aha, tuende kwa May 205. Give me 60%. $123,000. June, 60% of 208. $124,800. $124,800. So let's now agree on how the credit will be paid. We are told that the remaining sales are collected equally during the following 2 months. So the first 20% of April will be receivable in May. So give me 20% of 150. 30. So hiyo tunaileta hapa and the balance itachukuliwa hapa June. Hapo 30,000. Give me 20% of the sales of May. 20% of the sales of May. $24,600. So that one will be corrected here. But the other one, we don't have space for it. Turudi nyuma, tuangalie sales ya March. 20% for the sales of March. 20%. Oh, May is 41,000. 20%. Okay. 41,000. Thank you. Now give me 20% for the sales of March. Aha, 36. Wengine menyamaza. So here 36, it is being received in April, and part of it or the balance is receivable in May. So give me 20% for the sales of February. 20% for the sales of February. Yeah, 40,000. Now 40,000 is receivable in February, rather in March and in April. So we have 40,000 here. Then we have now to get the loan. Now, for the bank loan, according to information 3, we are told it is 45,000 that will be receivable in the month of May. So May here, 45,000. So that is all. Give me the receipts now. April. Add the 3 of them. Niambie April ni ngapi? I can see for May, May is 234,000. Alafu June 195,800. What about April? Or April ndio 166,000. Okay. 166,000. 166,000. Okay, let's now go to the purchase of assets. We are told that the assets will be acquired in April, 16,000. So April, we are buying 16,000 here. May, we are buying 65,000. Haya, tuende kwa materials. Materials tunaambiwa creditors for materials purchased are granted 1 month credit after month of purchase. So that means you pay the following month. You are given 1 month credit, you pay the following month. So that is straightforward. So if you are paying, they are granted 1 month credit after the month of purchase. So in April, we are paying the one for March, which is 5,500. 5,500. The other one is 6,600. I'm doubting my interpretation on that. Let me look at it. Creditors for materials purchased are granted 1 month credit after month of purchase. I think that one should be 2 months. What do you think? You are given 1 month after the month. So what do you think? We are told they are granted 1 month credit after month of purchase. So after, yes, I think that is how it should be, 2 months. That is 2 months. Because it is 1 month after the month of purchase. So kama ungeambiwa after 1 month, unalipa the following month, but they are saying 1 month after the month of purchase. So that means in April, we are paying what was acquired in February, 62,000. That is what we are paying. Then hapa tunalipa 5,500. Na hapa tunalipa 6,600. Okay. Haya, tuende kwa huyu mwingine anaitwa production overheads. We are told monthly production overheads include depreciation of 5 million per month. I told you depreciation never appears in a cash budget. Depreciation never appears in a cash budget. Therefore, in the amount, we are going to raise the 5 million. So kwa April tutalipa 12,500. 12,500. Hapa tutalipa 12,700. And hii ingine tutalipa 11,400. Depreciation never appears in a cash budget. The next one is what? The selling. Selling, we are told they are paid 1 month after the month in which they were incurred. So if it is 1 month after the month, so that is also 1 month. I think this is also 2 months. 1 month after the month. Hii Kiingereza yao. Paid 1 month after the month. It's also 2 months. So if it's 2 months, the selling we got there February 12,400. Ndio tunalipa 12,400. Hii ingine tukuje tulipe 15,500. Na hii ingine tukuje tulipe 18,900. 18,900. Haya, tuende kwa sales commission. Sales commission, 3% on sales is paid to the salesman each month. So 3%. So tuende kwa April. Niambie 3% of 150,000. 4,500. 3% of 205. 6,150. 6,150 and 3%. Is it 6,150 or 615? Then 3% of 208. Okay, so now the next one. 6240. 6240. Good. Salaries tunaambiwa namna gani? Salaries are paid at the end of the month. So hiyo tunalipa that month. So in April tunalipa 36,000. Ingine tunalipa 40,000. Ingine tunalipa 48,000. 48,000. Then tax tunaambiwa it is due in April, so tunalipa April 20,000. 20,000. So tell me what is the the total now payments April. Total payments for April. $163,400. Give me the total payments for May. The total payments for May. $189,850. June. $145,000, $140,000. So let's now go to the balances. Let's go to the balances. So to the balances, you will give me the surplus here of the deficit. 166 minus 163, 400 is what? $2,600. This is 2,600. Give me the surplus in the second month. Oh, someone is asking how I got the production overheads. Production overheads, tulikuwa tunangoa 5,000. You see, like in the month of April, Kenya, there is 17,500. So hiyo 17,500, because tunaambiwa kuna depreciation ya 5, unaitoa unapata 12,500. So hii 1,200 ndio tuliweka hapa, 12,500. The same thing for the others. Is that okay, Linda? Rainbow. Now, I was asking for the surplus hapa, May. Good, good. 44,150. The next one, that is a deficit. A deficit of how much? $56.60. Oh, it's still it's a surplus, by the way. $56.60. Yeah, that is still a surplus. Still a surplus. Yeah. Then the opening balance. The opening balance tunaambiwa by information what? Information 10. That the cash balance was 144,500. So kuja hapa weke 144,500. So add this one. 2,600 plus 144,500, we get what? $147,100. Get 147,100. Then 147,100 naileta hapo, ongezea 44,150. 44,150. $191,250. Haya, hiyo 191,250 leta hapa, ongezea 56.60. $241,910. 241,910. Yeah, so that is the cash budget that the examiner had required the candidate to answer there. Good. Let us proceed now to huyu mwingine anaitwa nani? Question 4. Question 4, discuss 4 limitations that a firm might encounter when operating marginal costing system. I think I gave you notes on marginal costing and absorption costing. You can check those limitations, the disadvantages, the challenges. Okay. Then we are told Great Limited manufactures and sells a single product branded GM. The cost data for the product is as follows. So we are given all that. And we are told to prepare the profit and loss statement based on marginal costing and absorption costing. Okay, that is a good one. So if it's a good one, we need to work on it. Need to work on it quickly. I told you, anytime you see these reporting method questions, the very first thing that you need to get is called what? Is called the unit cost. You need to get the unit cost. And in the unit cost, you start with marginal. Now, marginal take the variable. Marginal take the variable production costs. So you can see hapo tumepewa variable per cost per unit. We have direct materials of 60. We have direct labor of 120. We have variable production overheads of 40. It is followed by fixed production overhead. That one is not variable. You don't include it. And then variable selling overhead. That one is also not going to be included because it is not a production cost. That is not a production cost, it's a non-production cost. So with that, add and give me the cost there. It is 220. Then from there, you are supposed to get the fixed overhead absorption rate. The fixed overhead absorption rate. Now, the fixed overhead absorption rate, we are already told that it is 80. So that one you bring 80 there. You put 80. I'm saying that one is 80. The fixed overhead absorption rate is 80. But if they had not computed for you, you are supposed to use the formula of the OER, fixed budget, fixed overheads. You divide by the budget units. Now, in this case, what we are given is per month, but we are not told, yeah, you can still compute it. Can you check whether this is the same thing, eh? Whether this is the one that will give us. If you are to take 2.4 million, you divide by the units that are produced per month in information 2, 30,000. Is it the one giving us 80? Good. So those are the two possibilities. The first possibility is that the examiner will have given you the answer like he has given. Or the second possibility, he will give you the total and the units. Then you're supposed to compute using the formula that we already know. Yeah, but in this case, he has already done for us. Haya, kutoka hapo, you now bring the absorption. You bring the absorption. And I told you absorption takes the marginal and the fixed. So we are going to take the 220 and you add these 80. 220 plus 80 is going to give us what? It's going to give us 300. That is the first thing that you should always get when you come across that. The next thing that I told you you should always seek to get is called the stock schedule. It's called the stock schedule. The stock schedule. Stock schedule is the other word for the stock budget. For the stock budget. Though the presentation is slightly different, but the contents are the same. In this case, we have 2 months. So we will have details here. And in the details, we always begin with the opening stock. You add production. You add production. You less sales, and that gives you the closing stock. That gives you the closing stock. We have 2 months. We have the month of January and we have the month of February. We have 2 months. So, kuja hapa tuweke naitwa nani? Opening stock. We are not told. We are told there was no opening, work in progress as at the start of January. So January there was no opening stock, but production was 30,000 units and sales were 26,000. So that means we must have closed with 4,000. We must have closed with 4,000. Closing there becomes the opening here. And production is 30,000. And sales zikakuwa 34,000. So that means we closed with 0. We closed with 0. So if we closed with 0, now we are told to prepare. We are told to prepare the statements. So I want to start with margin. Let me adjust my camera kidogo. Tusaidie to capture good space. Yeah. So we want to do marginal costing. Income statement. Marginal costing income statement. So we have so we do have details here. And we have the month of January. And we have the month of February. The month of February. So in that, what we shall do, nakuja hapa, naanza na sales. Sales, the selling price is 400. So this will be 400 times 26. I hope my space tatoshea workings. 400 times 26 is how much? So 10,400. If my figures are in thousands, it's 10,400. And in February, it is 400 times 34. 400 times 34 is how much? $13,600. Then you say less opening stock. Now, opening stock in the first month, it is 0. So you are supposed to take the cost of marginal, which is 220, multiplied by 0, and the answer will be 0 there. And on this side, it is 220 multiplied by the units, which are 4. So 220 multiplied by 4 is 880. Naiandika hapa. Then you bring production. Production, again, you take the cost in marginal, 220, multiplied by the units that were produced, 30. So 220 multiplied by 30 is how much? $666. So 6660. On this other side, it is 220 multiplied by, or the production was also 30. So it's 6,600. Closing stock. Closing stock, it is 220 multiplied by 4. This is 880. And this side, it is 220 multiplied by 0. That is 0. So with that, we get a figure known as the cost of sales. Cost of sales. Now, cost of sales, yeah. 6,600 minus 880 is how much? $57.20. $57.20 brackets equal 880 plus 6,600 is how much? 74.80. 74.80. After with that, when you less them from sales, I told you you get a figure known as gross contribution. Gross contribution. Gross contribution. So gross contribution hapa, 10,400 minus 57.20 is what? 46. Sorry. I was waiting for the 10. That is 46.80. 4680. I believe this is the other one, ndio mnanipea 6120. 6120. Okay. Then from there now you say less variable production costs. Variable production costs. Variable production costs. So the variable production costs is the one they had called variable selling overhead. So let's just call it selling overhead. Selling overhead. And this selling overhead, you can see it is so the variable overhead is 30. So you are supposed to take this 30, and this non-production, we always multiply with the unit sold. With the unit sold. So multiply by 26. So 30 multiplied by 26 is what? 780. So here unawekwa hapa, and then 30 multiplied by 34. 30 multiplied by 34 is what? 1020. Is 1020. Now, when you raise these ones, you get now a figure we call net contribution. Net contribution. So subtract 780 from 4680. When you subtract, what are you getting? 3900. The next one, 5100. 5100. Then kutoka hapo sasa unasema less fixed costs. Now the fixed costs, you start with the production. The ones of production. So for the production, we have the overheads. We have the overhead, just one, which we are told for the month, it is 2,400. Now this is the same, kila mahali hapa, 2,400. Then you bring non-production. The non-production. So the non-production is going by the name selling overhead. So we just call it selling. So this will be 1,800. 1,800. So with that, we are now able to report our net profit. We are able to report our net profit. Our net profit. Net profit in the first one is negative 300. And the second one is 900. Okay. So that is how it is supposed to be done. That is how it's supposed to be done. Now from there, let us do the absorption costing. The absorption costing. So absorption costing, income statement, and here we have details. We have the month of January, and we have the month of February. So the procedure remains the same. We begin and get the what? Sales. So sales, again, unachukua the selling price. The selling price is 400 multiplied by the units sold. 26. 400 multiplied by 26, tulikuwa tumepata nini? $10,400. Alafu hapa 400 multiplied by 34, ndio tulikuwa tumepata 13,000. What? 600. Haya, then unasema less opening stock. So in the first period, opening stock is 0. But when we are in absorption, each unit is being valued at 300. So 300 times 0, that gives us a 0. But on this side, it is 300 times 4. 300 times 4 gives us what? 1,200. Naiandika hapa. Haya, production. Production, it is again 300 per unit. The units produced are 30. So 300 times 30 is what? 9,000. Alafu, this other one is 300 times the 30 as well. That is 9,000. Then unakuja kwa closing stock. This is 300 times 4. This is 1,200. It's supposed to be subtracted. And this is 300 times 0, which we are subtracting. And when you subtract, you get yourself a figure known as cost of sales. You get a figure known as cost of sales. So in the cost of sales, the first month, we have what? 7,800. The second month, we have what? $10,200. So with that, we get a figure known as the gross profit. When you are in absorption, it is called gross profit. Sasa niambie, in the first month, it is how much? $2,600. 2,600. And in February, 3,400. 3,400. Sasa kutoka hapo unasema fixed production cost. Fixed production cost. Now in this fixed production costs, we begin with absorbed. We begin with absorbed. Absorbed. Absorbed, unachukua the OER. The OER is 80. Una multiply na the units that were produced. The actual production, 30. So 80 times 30 is what? 2,400. Naiandika hapa. You do the same case here. 80 times 30. That is 2,400. Then you bring the actual. The actual. Actual ni hiyo imepeanwa hapo kwa swali. The budget. But kama some other questions will tell you the budget figure and the actual figure. So ile imepeanwa kama actual ndio unastahili kuleta. And in this case, it is 2,400. 2,400, and it's coming in to be subtracted that way. Now, when you subtract, you get an over. Kama iko over, it is going to be added, or you get under absorption. That will be subtracted. And sasa hiyo figure huwa inaletwa hapa. Now, all of them are zeros. All of them are zeros. Lakini kama moja ingekuwa over, we would have added, ingekuja hapa ikiwa positive, na ingine ikuwe under, ingekuja hapa ikiwa negative. Haya, after that now, you bring non-production costs. Non-production costs. Non-production costs, we start with the variable ones. Now the variable, we have the selling. Selling ni vile tu tulisema in the other, in marginal, tukasema ni 30 bob. You multiply by the units produced. Sorry, the units sold. So 30 times 26. $780 inaletwa hapa na itakuwa ya kusubtract, na hapa 30 times 34. 30 times 34 ni 1020. 1020 na ya kusubtract. Then we bring the fixed ones. The fixed, they are also selling, just selling. Kuna zingine, but there are some questions that will have several varieties. So that one, you just bring it the way it is. It is 1,800. And something else you should take note of, there are times that the fixed cost will be given for the whole year, but you are making a statement for just 1 month. So that cost, you are supposed to divide it by 12, or you are making a statement for 3 months. You are supposed to make it to be 3 months. Yeah. So the same case here, 1,800. So with that, now we are good to get our net profit. Good to get our net profit. The first one, $20. Second one, $580. Okay. So after that now, you do a reconciliation statement. We are now designing reconciliation statement. In the reconciliation statement, we have details. We bring marginal income profits, marginal profits. Marginal profit, you say less difference in opening stocks. In opening stocks, you add difference in closing stocks. And after you have done that, you get yourself a figure that we call absorption profit. Absorption profit. So this one will be done for a month we are calling January. And another month we are calling February. Yes, that is the format. If I'm remembering well, hii ndio imekuwa ya January na hii ni 580. Haya, nikumbushe hii marginal January, it was what? It was minus 300 na 900. So minus 300 na hii ni 900. So what you do, unaenda, yeah, good. Sasa utaenda kwa the statements, vile income statements zenye tumekuwa nazo, and uangalie the opening stocks. January walitumia nini kwa marginal na kwa absorption. I think the opening stock in both is 0. So there is no difference there. But in February wa marginal walikuwa na 880 na wengine wakikuwa na 1200. So what is the difference between the two in February? The difference between the two, 320. Haya, sasa hiyo I believe is the same difference in January for the closing. Now tell me the difference for the closing stocks in February. Difference is 1800. Now tell me whether they reconcile. If you take this, less this, add this, are they agreeing? Oh, see 1800. What is it? The difference in the actually is 0. Supposed to be 0, eh? Equals 0. Yeah. Yeah, it's 0. So kama ni 0, so are they reconciling? Good. I can see it's already 8. Oh, Vera, you don't do the reconciliation if you have not been asked. In the exam, don't do anything you have not been asked. Not unless you already have solved everything else and you have a lot of time, or it happens that this is the only question you can answer. Yeah, but in the exam, just provide what they have required. Yeah, but now for me, now that I'm teaching, I have to show you because there are some questions that will require that. I was saying it is already time. Na hii swali question 5, naona question 5B we solved in class. We solved in class. So now that most of us are in the house, I'm assuming. Can we finish 5A? Ndio hiyo karatasi tukue tumemaliza. Anyone who will be inconvenienced? Let me ask those who can be inconvenienced so that we don't inconvenience anyone. There is always another time. Anyone who has a problem, if I extend up to 8:20 to finish part A. Okay, so if we have no problem, or I should ask the other way around, should I extend? Let me ask that way. I don't know how many people will say yes. Should I extend and finish that question so that your karatasi iko imeisha? Okay, can see the yeses. Yeah, I'm seeing 3 yeses and we are how many? We are 8 so far. Wale wengine watano, what are your views? Yeah, I think most of us are okay with that. Hope no one is offended. So, question 5A. Question 5A. Nasema, Quivo Limited manufactures and sells a single product branded QV. The following information relates to product QV for the month of March. We have materials, conversion cost, variable, selling price. The dealer's margin is equivalent to 10% of selling price. So that means the margin, let's start with working straight, workings. So the margin, which is equal to profit, we are told it is 10% of the selling price. So 10% of the selling price, 2,000. So that means the profit is 200. Oh, Martin is saying he's not okay. But he wishes that I continue. Martin, I will send the recording right away, or tomorrow in the morning. And again, tomorrow I will not be available for the class. Tomorrow I will not be available for the class, but I will send you, I will look for a video that has a revision I did last semester. You watch during that time. I will also send that. So after this, I will upload this one and I will upload another one. Yeah, because tomorrow I have to attend a function in school where my daughter schools. Nimejaribu kuhepa nikaambiwa siwezi. Okay, so Martin, I hope that is fine. If you have not left. Okay. So the total fixed cost during the period was 25 million. The sales department indicates that the current sales during the period amounted to 90,000. The production capacity utilization is 60%. So production capacity, we are told 60% is 90,000 units. So we would wish to know 100% is what percent, is how many units. So this will be 100 times 90,000 to divide by 60. Ndio tujue at 100% what will be the capacity. What will be the capacity? 150,000 units. 150,000 units. Good. The company has, in the recent past, faced an acute competition that has negatively affected sales targets. The marketing manager has presented the following two options for increasing sales. One is reduce sales price by 5%. So under option A, selling price will be 95%. So it is the 95% of the current selling price of 2,000. So how much would that be? That is 1,900. Option 2, increase dealer's margin by 25% over the existing rate. So option B, you increase the dealer's margin by 25% over the existing rate. So the new margin will be, you increase it. So when you increase, it will be 125% of the current 10%. So we are going to pay him what? We are going to pay the dealer what percent? 12.5%. So 12.5%. Okay. So recommend the option the company should adopt if the company desires to maintain the present profit. Recommend the option the company should adopt if they desire to maintain the current. Okay. So what now we do? Teremuka tu hapa. So if they want the current profit, okay, so we have details here. We have details. Then we have currently. Then we have option A, and then option B. So we are going to have the selling price. Selling price. Now selling price in the current option, it is 2,000. In option A, we will reduce the price to 1,900. And in option B, the price will still remain 2,000. We are not changing the price there. Then you less variable costs. You less the variable costs. Lessing the variable costs, the first one is materials. Material, it is 800 upper. Even here, it is 800, that is not being affected. And even here, it will still be 800, it's not affected. Conversion, it is also what? It is 600, it's not affected. That way. Then we have the margin, or let's call it the commission. The commission that you are giving the dealer. The commission for the dealer, hapa tunampea 10%. So 0.1 of 2,000. Hiyo ni 200. We are giving him 200. Here, we are also not changing his commission. So it is 10% of 1,900. So anakura commission ya 190. But on this side, it is 1.25 of 2,000. 1.25 of 2,000, or rather 0.125 of 2,000. Is 250. Sasa, when you raise those ones, when you raise those ones, you get contribution margin. Contribution margin. Contribution margin, in the first case, it is how much? 2,000 minus 800 minus Guinea. That should be 400. Good. Aya, kule kwingine. $310. Kule kwingine. $350. Okay. The next thing is now this question, they are not telling us when they do this, how it will affect the sales. How it will affect the sales. Whether they will be able to operate at 100%. Whether they will be able to operate at 100%. That is now but we are told if they desire to maintain the present profit. Present profit. So that one we require now, we avoid the table. We do that's contribution margin. So I need to multiply this by the number of units. And then I raise the fixed costs so that I know what is the, okay. Haya, so inabidi nirudi hapa juu. Want to do a working, my change to this side. Haya, so this is what I'm saying. Takuja hapa tuseme profit is equal to contribution margin multiplied by X, the units, minus F. Ile formula tunatumia kwa CVP. Hope you remember CVP. So currently profit should be equal to 400 multiplied by the number of units. Zile tulikuwa tumeambiwa it is 90,000. Then you raise the current fixed cost. Fixed cost is the same. It is the same. You can even ignore it. 25 million. 25 million. So based on that, tell me what profit should be. What profit should be. $11 million. Now, if we go to option A, we will now say 11 million should be equal to the contribution of 310 X. We do not know X in how many units. Then you minus 25 million. Solve that and tell me X is how many units. Solve and tell me X is how many units. Aha. 116, 129. So that is 116, 130. 116,130. I told you when you're dealing with the break-even issues, units are always rounded up. But hata ukiandikia exam na hiyo 129, you will not get it wrong. Let's go to option B. Option B, we still want to make the same profit of 11 million. But now hapa contribution margin is 350 X minus 25 million. So based on that, tell me X will be what? $102, 857. Okay, so what do you advise? Should we go for option A or we should go for option B? We still want to or we should retain the current? Should we retain? Should we go for A or for B? What do you think? Yes, thank you, Jacinta. We should retain the current. Why do you think we should retain the current? Time imeenda, let me explain. We should retain the current because current, we are making 90,000 units and making a profit of 11. But unaona hii nyingine hii nataka tufanye 116 na hii tufanye 102. So why should we do more and get the same profit? So if we can do less and get the same profit, the better for us. So that's why we are saying that we go for that. So thank you so much. We come to the end of our today's class. As I've said, tomorrow I will not be available for the lesson, but I'm going to upload, I think one of the videos I revised. I'm going to check. I think I'm going to check. Yeah. So you look at it as revised. Lakini sasa hiyo karatasi, hiyo tumemaliza. We shall pick up from there next time. Thank you so much. Good night.